Well, welcome to it. Time to have another check-in on the markets following the very red open that we saw on our local exchange. But that theme of redness, negativity, filtering through right from Asia to Europe, and then, of course, looking at the JSE All-Share Index. But the Asian picture, even though it was negative, was a bit of a mixed bag because we saw the Chinese markets leading the gains in that particular side of the world, with the stock gains a little bit higher. Hang Seng Index in closing in positive territory, up about 0.9%. And it's the investor sentiment around China that perhaps did lift markets on that particular front a little bit higher, especially when we see some of the positive developments happening in Shanghai relating to the COVID-19 situation. But nonetheless, investors having to deal with the fact that we're still dealing with Russia-Ukraine tensions, as well as COVID-19 lockdowns in China, exacerbating the idea that perhaps inflation hasn't reached its peak yet, coming in at 8.3%. versus the consensus of 8.1%. It may have come down a little bit, but not at the pace that would have made investors a little bit encouraged that aggressive monetary policy might be the norm, but we won't have to go as aggressive as the Fed might not like to entertain. But nonetheless, when we look at the European markets, negative across the board. German DAX about down 0.2%. French CAC also down 2.25%, and also in negative territory we're seeing the FTSE 100. But the All-Share Index, that's what everyone's been talking about, our local markets that opened about 2,000 points lower, led down by the resources that are currently down at this point around 6%, followed by the industrials and the financials in negative territory. And the concern is that even though the Fed will have to step up the pace of aggressive monetary policy to tame inflation, it may bring at least a downturn or a recession, which is not necessarily good for markets that have been accustomed to easy money. But to talk to us about the dynamics and at least how he's seeing the markets picture, we are joined by Han Tan, who's a chief market strategist at Xfinity. Han, thank you so much for your time. I want to ask you about the market sentiment at this particular point, but it almost feels like a bit of a redundant and very obvious question, seeing that we are seeing red across the board. But nonetheless, I'm going to ask you, what do you make of the price action that we're seeing right now? Han, if you can just unmute your mic.
Hopefully this works. Can you hear me now? But yeah,
Yes,
overall,
we
I
can
think
hear
that
perfectly.
market sentiment is still souring, given the drops in global stocks. I think the data still points to persistently elevated inflation, and one that really amplifies the downside risks to the U.S. economy. Now granted, monetary policy operates on a lag, so keep in mind that the Fed has got more rate hikes planned for the rest of the year and beyond. But I think ultimately markets are looking for a trend that either inflation is decelerating or that the US economy can continue staying resilient in the face of those higher CPI and those rate hikes.
So when we look at that CPI figure, I mean, one of the concerns that has been raised by a lot of the economists is that we're seeing inflation moving from the goods side to the services sector, and that the Fed may have to do a whole lot more than they're anticipating to tame inflation. And I'm wondering whether you're considering the idea that perhaps 75 basis points might not necessarily be out the window yet. They may have to actually give themselves some options.
Yeah, indeed. And I think if you're being truly honest, I don't think that 75 basis point hike was ever really out the window, so to speak. Despite what Fed Chair Powell had said last week, if you look at the Fed speak that has come out since, their refusal to actually overtly rule out that 75 basis point hike shows that it remains an option. And so if the inflation doesn't accelerate, and then it really puts the pressure on the Fed to trigger that outsized move. It's like firing 3 bullets with that one shot, because the Fed is really lacking in its credibility here, and there are some serious doubts about whether they can actually get ahead of the inflation curve.
So when it comes to that credibility, because I've heard a lot of analysts talk about Fed credibility at this particular point, what will be needed in order for that credibility to come back on track? Does Fed Chair Powell pull a Paul Volcker hiking interest rates in order to break the back when it comes to inflation? Is that what's needed?
Well, I think first and foremost, markets will be using the scenario that the Fed adheres to as that benchmark, i.e., a soft landing, and whether the Fed can actually engineer that or not. But here's the thing: I think markets are expressing enough doubt and skepticism that can actually be achieved. And then markets are already bracing for the prospects of a recession. But I think ultimately, markets are still okay with that, or at least trying to come to terms with that, as long as the Fed can actually try to cool down inflation. I think the worst case scenario for the Fed is if, despite their rate hikes and CPI stays elevated, I think that could really trigger a confidence crisis in the Fed.
Who has a tougher job at this particular point? Is it the Fed, the Bank of England, or the ECB?
Of those three you mentioned, I would have to say the ECB. Keep in mind, and I would echo what President Lagarde had said, in recent weeks and months, that the ECB is coming from a different place from the Fed. The ECB is in negative interest rates territory. Granted, the red-hot inflation has seemingly paved the way for the ECB to get out of that negative rates regime, but they still have a war that's raging off to their eastern flank. They are set to suffer the most direct impact from more disruptions to Russian energy and fuel exports. So I think the downside risks, given their proximity to the Ukraine conflict, would pretty much tie the hands of the ECB moving forward, or at least not give them as much policy bandwidth.
Right. The other aspect that markets were definitely focusing on, apart from the US CPI figures, was the interesting correlation, especially when it comes to the movements of cryptocurrencies along with equity markets, and that correlation between cryptocurrencies and the NASDAQ in particular. Is that fascinating for you? Because all this time the argument has been that cryptocurrency is an alternative asset, perhaps a hedge for inflation, but the recent performance seems to suggest otherwise.
Yeah, indeed, and I think you've taken those words out of my mouth there. So that correlation really dilutes the narrative that Bitcoin and cryptos in general can actually be that viable hedge. And I think some of the dislocations, so to speak, to put it mildly, in the stablecoin universe as well, shows that the industry is still very much in its infancy. Now, to be fair, again, that asset class is still, well, some might even argue it's not yet an asset class, but now I would use that term here. It's still got a lot more to prove, and it's had a shorter amount of time to prove compared to, say, how long tech stocks have been around, right, for many, many decades. So, but perhaps another commonality, to put a more positive spin to it, is for proponents of crypto or even tech stocks for that matter. This sell-off or meltdown could present a potential buying opportunity for those who have got the risk appetite and for those who have got the longer term horizons, and this could be quite the opportunity for them.
In terms of events that you're keeping an eye on, or perhaps data, before I let you go, what's on your radar right now?
Yeah, indeed. I think arguably the inflation data is the single most important piece of data that the world is watching. When it comes to, say, non-farm payrolls, markets are used to that, and the Fed is expecting as much as well, that resilience in the US labor market. Now, of course, if there is a contraction in the jobs market, then that will be a red flag as well. But overall, I think it's very much centered on inflation by way of commodity prices, and then what the Fed and central banks around the world intend to do about it. That's the primary focus for markets right now.
All right, Han, let's leave it there. Thank you so much for your time. And of course, we will continue monitoring a lot of the market developments as they play out, especially as the heat increases from a US point of view with the midterm elections around the corner. But that is it from me.